In the summer of 1720, shares in the South Sea Company were worth more than all the gold and silver in Europe combined. By autumn, they were worthless. The company itself? It had never conducted any meaningful trade. It owned no ships worthy of the name. It sold nothing, produced nothing, and had no viable business model whatsoever. Yet this phantom enterprise didn't just fool commoners and country merchants. It ensnared the greatest minds of the age. Isaac Newton, the man who discovered gravity, who revolutionized mathematics, who was arguably the smartest person alive, lost the equivalent of tens of millions in today's money. When asked about predicting the stock market afterward, he famously said, "I can calculate the motion of heavenly bodies, but not the madness of people." But here's what doesn't make sense. This wasn't some dark corner of the financial world. The King of England was involved. The Chancellor of the Exchequer was involved. Members of Parliament were involved. The entire British government had essentially bet the nation's future on what was, fundamentally, a lie. How does an entire country, the most powerful empire on earth, fall for a scam so obvious? And more importantly, why does this exact pattern keep repeating throughout history, right up to today? The answer is more disturbing than you think. To understand how Britain bankrupted itself, we need to go back to 1688, 32 years before the bubble burst. England had just gone through the Glorious Revolution. William of Orange had taken the throne, but there was a massive problem. War with France was bankrupting the nation. King Louis XIV had the most powerful military in Europe, and fighting him required money England simply didn't have. The government's debt was spiraling out of control. Interest payments were eating up more than half of all tax revenue. Creditors were charging exorbitant rates because, frankly, lending to the government was risky. Monarchs had a nasty habit of simply not paying back their debts. England needed a financial innovation, and in 1694, they got one, the Bank of England. This was revolutionary. For the first time, a permanent institution would manage the nation's debt. Creditors could now lend to the government with confidence, knowing the Bank of England guaranteed repayment. Interest rates dropped. Money flowed. And a new concept entered British society: government debt that could be bought and sold as stocks. This created something unprecedented: a secondary market for government debt. You could buy a piece of England's debt, collect interest, and sell it to someone else whenever you wanted. It was liquid. It was tradable. And it made certain people extraordinarily wealthy. But the Bank of England had competition. In 1711, a group of wealthy merchants proposed a radical solution to England's debt problem. They would create a new company, the South Sea Company, that would assume a massive portion of the national debt in exchange for exclusive trading rights to South America and the Pacific Islands. The government loved this idea. Parliament loved this idea. And investors? They were about to lose their minds over it. But here's what nobody was talking about. South America wasn't really available for trade. Spain controlled it. And England and Spain were at war. The entire business model was based on access to markets that didn't actually exist yet. But the founders had a plan that would make them richer than anyone had ever been before, even if it destroyed the country in the process. The South Sea Company scheme was elegant in its simplicity and devastating in its execution. Here's how it worked. The British government owed money to thousands of different creditors: soldiers, suppliers, merchants, nobles. These debts paid various interest rates, typically between 5% and 9% annually. The government wanted to reduce these interest payments, but creditors obviously didn't want to accept less money. Enter the South Sea Company with a proposal. Creditors could exchange their government debt for shares in the South Sea Company instead. The company would assume the debt, and in return, the government would grant them a monopoly on trade with South America. On paper, this was reasonable. South America meant gold, silver, exotic goods, and the potential for enormous profits. If the company succeeded in trade, its stock value would soar, and investors would make far more money than they ever would from government interest payments. But the architects of this scheme, primarily John Blunt, a cunning and ruthless businessman, understood something crucial about human psychology. Perception matters more than reality. They didn't need to actually conduct profitable trade. They just needed people to believe the company would be profitable. And to create that belief, they needed the stock price to rise. So they engineered it. The company made several strategic moves. First, they bribed key government officials with free shares that would become valuable only if the scheme succeeded. The Chancellor of the Exchequer, John Aislabie, was heavily involved. King George I himself became governor of the company. Even the Prince of Wales was given shares. This wasn't just corruption, it was a masterstroke of credibility engineering. When the King of England is the governor of your company, who's going to question its legitimacy? Second, they created artificial scarcity. The company would offer new shares in limited tranches, releasing them slowly to the market. Each new offering would be priced higher than the last. When people saw the price rising from £100 to £300 to £500 per share, they didn't ask why. They just wanted in before it went higher. Third, they offered credit. This was the nuclear option. You didn't need actual money to buy South Sea shares. The company would lend you the money to buy their own stock, with the stock itself as collateral. You could buy shares with only a 10% down payment. Think about what this means. You could buy £1,000 worth of shares with just £100 of real money. If the stock doubled, you'd make £900 in profit on your £100 investment, a 900% return. This kind of leverage is intoxicating. It's also catastrophically dangerous. By early 1720, the scheme was in full motion. The stock price began to climb. £100 per share in January, £175 in February, £330 in March. And that's when the mania truly began. By April 1720, London had lost its mind. Coffee houses that usually discussed politics and philosophy now talked only of South Sea stock. Servants were quitting their jobs to become day traders. Aristocrats were selling their estates to buy shares. People were taking out loans, mortgaging their homes, liquidating everything they owned to get into the market. The stock hit £400 in April, then £550 in May. The price was rising so fast that even skeptics started to doubt their skepticism. When everyone around you is getting rich and you're sitting on the sidelines, you don't feel smart, you feel like a fool. Isaac Newton understood this intimately. He had actually invested early in the South Sea Company and made a handsome profit of £7,000. Then he sold, believing the price had gotten ridiculous. But as the stock continued to climb without him, he watched his friends and colleagues multiply their wealth while he sat with his modest profit. In June, unable to resist, Newton bought back in at the peak. He would eventually lose £20,000, equivalent to roughly $3 million today. The company's directors, meanwhile, were becoming spectacularly wealthy. They paid themselves enormous dividends. They sold shares at the peak while encouraging others to buy. They threw lavish parties and made public displays of their wealth, which only fueled more frenzy. But something else was happening beneath the surface, something that would prove critical: the rise of the bubble companies. Seeing the success of South Sea, hundreds of other ventures sprang up overnight, each promising revolutionary returns. These ranged from plausible to absurd to completely fraudulent. There were companies for trading in hair, extracting silver from lead, a wheel of perpetual motion, making salt water fresh, and most famously, a company for carrying out an undertaking of great advantage, but nobody to know what it is. That last one is real. A promoter opened subscriptions for a mysterious company, refused to say what it would do, collected thousands of pounds in a single morning, then disappeared. He was never seen again. The government was alarmed by these bubble companies, not because they were fraudulent, but because they were competing with South Sea for investment capital. So Parliament passed the Bubble Act in June 1720, which made it illegal to form companies without a royal charter. The intention was to protect South Sea's monopoly. The effect was to begin the collapse. In August, South Sea stock hit its peak, £1,000 per share, a 900% increase in 8 months. Anyone who bought in January and sold now had multiplied their money tenfold. But here is the problem with bubbles. Someone has to be left holding worthless paper when the music stops. And the smart money, the company directors, the politicians who'd been bribed with free shares, they were already selling. The collapse began quietly, then all at once. In August 1720, the Bank of England, which had been competing with South Sea for control of government debt, quietly stopped accepting South Sea stock as collateral for loans. This was a signal, subtle but unmistakable. The bank didn't believe the stock was worth its current price. Savvy investors noticed. They began to sell. Then the company made a critical mistake. They demanded payment on the loans they'd extended to investors to buy stock. Remember, most people had bought on credit, putting down only 10% of the purchase price. Now the company wanted the other 90%. But here's the catch. Investors didn't have that money. They'd planned to pay the loans back with their profits when they eventually sold. Being forced to pay immediately meant they had to sell their shares to raise cash. As selling pressure increased, the stock price began to fall. £900 per share, then £800. The decline was manageable at first, almost expected after such a meteoric rise. But as the price fell, margin calls kicked in. Banks and lenders demanded that investors either put up more cash or sell their shares to cover their loans. This created a cascading effect. Forced selling pushed the price lower, which triggered more margin calls, which forced more selling, which pushed the price even lower. By September, panic had set in. The stock fell to £700, then £600, then £500. People who'd bought at £1,000 were now underwater. Those who'd bought on maximum leverage were completely wiped out. And the company's directors? They tried everything to stop the bleeding. They announced a massive dividend, but it was obvious this was impossible given the company had no real revenue. They made public statements about future trading prospects with Spain, but everyone knew Spain had granted no such trading rights. The lies that had worked on the way up were transparent on the way down. By October, the stock was at £150, an 85% crash from the peak. By December, it was back to roughly £100, where it had started. Fortunes that had existed only on paper evaporated. People who'd been millionaires in August were destitute by December. Suicides followed. Families were destroyed. The economic devastation rippled through every level of British society. And Britain itself? The government had tied its financial credibility to the South Sea Company. Now that credibility was shattered. The Bank of England had to step in to prevent complete financial collapse, but the damage was done. The question everyone was asking, how do we punish those responsible? The public demanded blood. Parliament launched an investigation in 1721. and what they uncovered was staggering. Company directors had bribed dozens of government officials with stock and cash. They'd manipulated the share price through coordinated buying. They'd knowingly sold shares at inflated prices while telling investors the stock would go higher. They'd loaned themselves millions from the company treasury and never paid it back. Several directors were arrested. Their estates were confiscated. John Blunt, the mastermind, had his wealth reduced from £183,000 to £1,000. He was allowed to keep just enough to survive. The Chancellor of the Exchequer, John Aislabie, was expelled from Parliament and imprisoned in the Tower of London. But here's what's revealing. Not a single person was executed. Not one received significant jail time. Most of the bribes were too well hidden to prove. Many guilty parties were too well connected to prosecute. And the king himself had been involved, which made a full accounting politically impossible. The South Sea Company itself wasn't dissolved. It continued to exist for over a century, managing a portion of the national debt, though it never conducted any significant trade. Most importantly, the financial innovations that had enabled the bubble, joint stock companies, tradable debt, leverage, none of these were banned. They were too useful, too integral to modern finance. The Bubble Act remained on the books, making it harder to form new companies, but the fundamental mechanisms of speculation remained intact. Britain had learned a lesson, but it was the wrong lesson. They thought the problem was a few corrupt individuals. They didn't realize the problem was the system itself, a system that rewarded reckless speculation and allowed collective delusion to override basic financial reality. And because they learned the wrong lesson, the pattern would repeat. Here's what should terrify you. The South Sea bubble wasn't unique. It was the template. In 1929, the US stock market crashed after a decade of speculation fueled by easy credit and margin buying, the exact same leverage that destroyed South Sea investors. People had borrowed money to buy stocks, then used those stocks as collateral to borrow more money to buy more stocks. When prices fell, margin calls cascaded through the system, triggering the Great Depression. In 2000, the dot-com bubble burst. Technology companies with no revenue and no path to profitability were valued at billions of dollars because investors believed the internet changed everything. Pets.com spent millions on advertising to sell pet food online at a loss. When it collapsed, investors lost $840 million. The company had existed for 268 days. In 2008, the subprime mortgage crisis nearly destroyed the global financial system. Banks had created complex financial instruments backed by mortgages given to people who couldn't afford them. They'd used leverage to multiply their positions, just like South Sea investors. When housing prices stopped rising, the entire structure collapsed. And today, we are watching it happen again, in real time, across multiple asset classes simultaneously. Consider cryptocurrencies. In 2021, Dogecoin, a cryptocurrency created as a joke, with no utility, based on a meme of a dog, reached a market capitalization of $88 billion. Let me repeat that. A joke currency was worth more than Ford Motor Company. Or NFTs. People spent millions on digital images that anyone could copy with a right click. The most expensive NFT ever sold went for $69 million. Today, 95% of NFTs are worthless. All meme stocks. In 2021, GameStop, a struggling retail chain with declining revenue, saw its stock price rise 1,500% because internet traders coordinated to create a short squeeze. Many bought in believing they'd get rich. Most lost everything when the price inevitably crashed. Or SPACs, Special Purpose Acquisition Companies, which allow companies to go public without traditional scrutiny. Between 2020 and 2021, over 600 SPACs raised more than $160 billion. The average SPAC is now down 40% from its peak. Many are worth less than the cash they raised. The pattern is always the same. 1. A new financial innovation or asset class emerges. 2. Early investors make spectacular returns. 3. Media coverage creates FOMO, fear of missing out. 4. Leverage and easy credit amplify the buying. 5. Rational objections are dismissed as old thinking. 6. Insiders sell to later investors. 7. A catalyst causes prices to fall. 8. Forced selling cascades through the system. 9. Latecomers are left with losses. 10. Society promises never again. 11. The cycle repeats with a new asset class. According to research by economists Reinhardt and Rogoff, there have been at least 8 major financial bubbles since 1720. Not 8 minor market corrections, 8 complete systemic collapses that required government intervention to prevent economic catastrophe. And here's the most disturbing data: the frequency is accelerating. The gap between major bubbles used to be measured in generations. Now it's measured in years. Why does this keep happening? The answer lies in human psychology and the structure of financial incentives. First, our brains are terrible at distinguishing between luck and skill during bull markets. When everyone is making money, it feels like validation. You're not gambling, you're investing. You're not following the crowd, you're being smart. Confirmation bias kicks in. You notice all the evidence that supports your position and ignore everything that contradicts it. Second, greed isn't the only emotion driving bubbles. Fear is equally powerful. Fear of missing out. Fear of being the one person who didn't get rich when everyone else did. When your neighbor has doubled their money and you haven't, you don't feel cautious, you feel stupid. Third, there's a collective delusion that this time is different. Every bubble comes with a narrative about why traditional valuation methods don't apply. In 1720, it was the unlimited wealth of South America. In 1929, it was the radio and mass production. In 2000, it was the internet. In 2008, it was the belief that housing prices never fall nationally. Today, it's blockchain technology and decentralization. These narratives aren't entirely wrong. The internet did change everything. But that doesn't mean every internet company should be valued at billions of dollars with no revenue. Fourth, and most critically, the financial system rewards short-term risk-taking. If you're a fund manager and you sit out a bubble, you lose clients to managers who are riding it up. If you participate and it crashes, you're not alone. Everyone crashed. But if you sit out and miss the gains, you're fired. John Maynard Keynes identified this problem in 1936. The market can remain irrational longer than you can remain solvent. If you're betting against a bubble, you might be right eventually, but you'll be bankrupted before you're proven correct. This creates a perverse incentive. Rational people make irrational bets because that's what the system rewards. The insiders who created the South Sea bubble knew it would eventually collapse. They just planned to sell before it did, and many succeeded. The same is true today. The venture capitalists who funded money-losing tech startups knew most would fail. They just needed a few to succeed, and they needed to exit before the collapse. The same with crypto promoters, SPAC sponsors, and meme stock influencers. They're not irrational. They're rationally exploiting a system that allows them to profit from other people's losses. So what can we learn from the South Sea bubble? First, when something sounds too good to be true, it is. Revolutionary returns require revolutionary risk. If someone tells you they can guarantee 50% annual returns, or that a particular investment can't lose, they're either lying or deluded. The South Sea Company promised both wealth and safety. It delivered neither. Modern equivalents are everywhere. Passive income. Get rich quick. Can't miss opportunity. These phrases are red flags, not invitations. Second, leverage is a weapon that fires backward. Borrowing money to invest multiplies your gains, but it also multiplies your losses. And when things go wrong, you don't just lose your investment. You lose everything and still owe money. The South Sea investors who bought on credit weren't just wiped out. They ended in debtor's prison. The 2008 homeowners who took out mortgages they couldn't afford didn't just lose their down payment. They lost their homes and their credit. If you can't afford to invest with cash you can afford to lose, you shouldn't be investing at all. Third, the crowd is not wise when money is involved. There is a concept called the wisdom of crowds, the idea that large groups of people are collectively smarter than individuals. This works for estimating the weight of a cow or predicting election outcomes. It fails catastrophically in financial markets. When money is at stake, crowds don't aggregate information. They amplify emotion. Fear and greed spread like viruses, infecting even rational people. Isaac Newton, literally one of the smartest humans who ever lived, couldn't resist the crowd. If Isaac Newton couldn't beat FOMO, what chance do you have? The only defense is to opt out. Warren Buffett has a famous rule: be fearful when others are greedy, and greedy when others are fearful. This is harder than it sounds because it requires you to feel like an idiot for extended periods while everyone else is getting rich. But the alternative is worse. The South Sea bubble destroyed lives, bankrupted Britain's elite, and nearly collapsed the government. It was a financial catastrophe that should have taught humanity a permanent lesson about the dangers of speculation. Instead, we've repeated it at least 8 times since. The question isn't if there will be another bubble, it's when, and what form it will take. Right now, multiple asset classes show bubble characteristics: private equity valuations, commercial real estate, certain tech stocks, and yes, parts of the cryptocurrency market. But here's what keeps me up at night. Each successive bubble has been bigger than the last, because each one requires more leverage, more debt, and more coordination to inflate. And each crash has required more aggressive government intervention to prevent complete systemic collapse. In 1720, the Bank of England barely managed to stabilize the situation. In 2008, it took trillions in bailouts and a decade of zero interest rates. Next time, we might not have the tools to fix it. Or maybe we will. Maybe this time really is different. Maybe we've finally learned the lesson. But probably not. 300 years later, we are still making the same mistakes, driven by the same emotions, creating the same disasters. The names change. The technologies change. Human nature doesn't. The South Sea bubble isn't ancient history. It's a preview of next month's headlines. So pay attention. Stay skeptical. And when everyone around you is getting rich from something you don't understand, remember Isaac Newton, desperately buying at the peak, convinced he'd finally figured out how to beat the market. He was wrong. You probably are too. If you found this video valuable, consider subscribing. And if you learned something, share it with someone who needs to hear it. The best time to prepare for a crash is before it happens. Now, if you'll excuse me, I need to check my investment portfolio. Wish me luck.